G'day, I'm Vince Scully, Portfolio Manager at Life Sherpa Invest, and this is investing. Today, we're going to talk about risk. It sounds like a scary word, but let me know what you think risk is. Is it about losing money? Is it about not being able to sleep at night? Is it about those terrible ups and downs, the red colour on your portfolio when you wake up in the morning? Let's get into it. So risk is the story of today. And when most people think about risk and investing, they think about permanent loss of their investment. And yet in a broadly diversified portfolio, that's practically impossible. And so that's the context we need to talk about risk. Of course, in a concentrated portfolio of individual shares, it absolutely is possible. And if you go back to the GFC, we saw quite a few of the larger Australian companies and several overseas companies fail, losing all of their investors' money. Some of these are pretty big names, Babcock and Brown, and a number of its satellite companies. Only Infigen, the wind farm business, survives. That's now been absorbed into Iberdrola, a $210 billion energy company listed in Spain. But we lost some other significant names too. Alco, City Pacific, MFS, and ABC Learning, to mention a few. And many of these companies we had a sell on in my previous business where we were recommending against investing in those. And these companies were the leading companies. They were delivering growth after growth after growth until they didn't. And few people were prepared to accept that they should forego their short-term glamour returns for recognizing the underlying lack of substance in these businesses. And that's the problem with individual companies, that it's easy to get caught up in the headlines, in the stories. And many of these companies manage their share price by announcements. GFC wasn't the only time these things happened. Much later we had Dick Smith, Virgin, Harris Scarfe, all household names. And before that, HIH Insurance and OneTel. So finance professionals, like portfolio managers, financial advisors, generally use volatility, that is the standard deviation of the share price, as a measure of risk. It's not the same as risk, but it's a good proxy for the purposes of building a portfolio. And that's what we're talking about. And so it's simply a statistical measure of how much the asset's value, the share price, deviates from its average, how wiggly the line is in a sense. Whereas risk, on the other hand, is the probability of permanent loss of capital. And understanding the distinction between the two is critical to being a successful long-term investor. Now, my good friend Nick Murray, who's sometimes referred to as the advisor's advisor, is dismissive of volatility, as is Warren Buffett for that matter. And many younger investors who have no personal experience of a serious, deep, prolonged market downturn tend to dismiss it because they don't have that visceral experience of waking up one morning and understanding how it feels to see your portfolio down 30%. Now, Nick argues that volatility is simply the ticket to returns, and that I agree with. He also argues that it's temporary, and that too is true. So Nick says, and this is his famous quote, "The decline is temporary while the advance is inevitable." And that's why he called his book aimed at individual investors, Simple Wealth, Inevitable Wealth. But this is only true on a spreadsheet. And this is often lost on the Reddit commentariat. Real humans lose money when volatility overwhelms their emotions, leading them to sell at the worst possible time. And that's how people lose genuine, permanent money. Of course, you can't avoid, and you shouldn't seek to avoid, risk or volatility. You need to embrace it, but only to the extent that you're rewarded for taking it and you have the stomach to survive it. Now, my personal take on this, and an approach that we take when we're constructing portfolios at LifeSherpa, is that the real risk that matters to individual investors is the probability of achieving your goal. And in an earlier episode where we looked at why we're investing, the key point of investing is to shift income from today to support spending at some point in the future. And that comes with a time frame and a monetary requirement. And so volatility matters in this context, even if it's not a perfect measure of risk in the traditional sense of losing money. But volatility matters because it drives the variability of the outcome. So how much your portfolio will be worth the day your deadline arrives. And volatility matters because it drives the likelihood of your emotions getting the better of you, leading to an inopportunely timed sale. And that's why it matters. Now, as portfolio managers, we use a number of tools, which I'm sure you can Google in your spare time. We use a Sharpe ratio, the Sortino ratio, for example. Both of these measure return per unit volatility. But you don't need to get this technical. Just think about this as risk-adjusted returns. So if I take more risk, I should get proportionally more returns. At some point, you do get a diminishing return. So as you move up the risk curve, the rate you earn extra return does fall off. And so that's what matters. And how you put that together to build a portfolio, we'll come back right after this.
This is Investing is brought to you by LifeSherpa Invest. If you want your money to work harder and not just sit in a savings account earning crumbs, check out LifeSherpa Invest. Choose from 4 risk-based portfolios like Everest 90 with 90% in growth assets. Long-term, low-cost and built for people who are after serious returns. Invest from $5K today at lifesherpainvest.com.au/invest and start climbing.
We led into the break talking about making sure that you're getting the right risk-adjusted returns. And the practical implication of that is that when you're putting together a decision around investing, you should look to take one of 2 approaches. Approach number 1 is to seek to maximise returns for the level of risk that you're comfortable taking. And the second approach is to minimise the risk for the level of returns you need. And both of these mean looking at every investment on 2 dimensions. And that's what we call expected return and volatility. Generally, we plot this on a scatter chart where we have volatility across the bottom and expected return across the top. And you're looking to get as close to the top left-hand corner as you can. Only unicorns sit right in the top left-hand corner, but if you can move up and to the left, that's good. And so if you take this approach, there's only 2 main ways that investors go broke: concentration and leverage, or worse, a combination of the 2. And in the later parts of bull markets, that is rapidly growing prices as we've been in for probably the last 15 years, that's when people seek to do both. And these are extraordinarily visible, and most people think they understand this when they start on that journey. So most people who adopt a geared approach would at least think they understand the risk they're taking. The third way, though, the third way investors lose money, that is a bit sneakier. And usually you only discover this after it hits you in the face. As Mike Tyson said, everyone's an aggressive investor until they get smacked in the face with a serious downturn. But where that becomes a problem is that if you accept volatility that you're not being rewarded for, or volatility that exceeds your emotional tolerance for it, that's where emotions beat rationality and people sell when they shouldn't. And this is an area of some debate. There's an old saying in investing that you can't eat risk-adjusted returns. And this keeps getting repeated, particularly on Reddit, by people who've signed up to the cult of equities or have more machismo than research. But the research does show over time that most individual unadvised investors underperforms the funds they invest in. Now that might sound a bit counterintuitive or a bit odd. So let me explain what that actually means. And this occurs because investors pile in to a fund when it shows good returns. And if you want to have a look at this, have a look at AIKK and look at the price chart against the inflows. But what that means is people pile in after the good returns have been achieved, usually just before the market turns or the manager's luck runs out, and they end up not capturing the returns of that fund. Morningstar, the big research house, publishes a regular report called Mind the Gap, where they look at investor returns compared to fund returns. So they look at the asset-weighted returns, so the returns for every dollar that's been invested in a fund, and compare it to the time-weighted returns, which is just looking at the returns per unit time. And what they found was that individual fund investors, this is US equity investors, earned 6.3% per year in dollar-weighted returns. That's the investor return over the decade to the end of 2023. But the funds they invested in earned 7.3%. So that's a 1% difference. There are other people who do this as well. Dalbar is another one. Their annual shows that the average US equity investor earned 9.2% compared to the S&P 500, the 500 largest companies in the US. So Dalbar do a similar sort of study, and they've shown that the average US equity investor earned 9.25% compared to the S&P 500, the 500 largest companies in the US, usually used as a measure of the market, returned 10.35. So that's about 1.1%. So a very similar sort of metric. And the other interesting thing that Morningstar discovered, and this is why it's important, is funds with high risk-adjusted returns, so not necessarily high returns, but high returns per unit risk, that the ones with the best risk-adjusted returns showed the lowest gap between what their investors earned and what the fund earned. So for the highest decile, so that's the funds with the highest risk-adjusted return, the gap was 0.5%, whereas in the worst 10% of funds, which may have had higher headline returns, but the investors experienced a bigger gap of 2.6%. And this is one of the most important and clear demonstrations to me why a 100% equity portfolio, which might have a higher expected return, don't actually deliver for investors, despite what you might hear or read on Reddit. So that's why at Life Sherpa Invest we don't have a 100% portfolio. Our most risky portfolio is a 90% growth portfolio. So in the end, what this all means is that diversification matters. Which leads us to ask the question, how do you decide how much risk you should take and how much risk you need? And that's where the real smarts in investing comes. And so we need to go back to our why here. That is, you need to start with your goals and time frame. So if your time frame is less than 3 years and it's a hard deadline, your money has no business being in the share market. On the other hand, for a longer time frame, inflation's a bigger risk and time is your friend. So you can and should take some more risk. So the starting point is to come back with your goal and time frame in mind and assess your needs against the 3 levers. If you remember from an earlier episode, the 3 levers when it comes to investing is time, return, and savings. And this will tell you how much risk you need to take. So look at how much you can save, look at your time frame. That will tell you what return you need in order to achieve your goal. The second thing you should look at is how much risk you can recover from. That is your capacity for risk. So a young person with a good steady income investing a fraction of a year's pay will have a very high capacity to recover because you can always earn some more. On the other hand, a retiree investing their life savings will have a very low capacity to recover because their ability to earn an income has now disappeared. And the final aspect is your tolerance for risk. And this is where we need to have a look at this. So on the screen, you'll see for those of you on YouTube, this is how we look at this at Life Sherpa. So starting with how much risk you need to take, how much risk you can tolerate, and how much risk you can recover from. The middle one is the psychology of all of this. That is your risk tolerance. And many younger investors, particularly those under 40, who weren't investing at our last big downturn, the global financial crisis in 2008, tend to overestimate their tolerance for risk because it's never been really tested. The only time it's been tested is in COVID. So if you remember back to March 2020, the Australian share market fell 32%. But it was all over in 90 days, and we were far more concerned about staying alive than what our portfolios were doing. So this is something you need to experience for yourself. And so a traditional risk profile, you'll find lots of these quizzes on the internet. A traditional risk profile is what psychologists call a stated preference. So that's you telling the inquirer what your tolerance for risk. That's how you feel that you think about risk. And for an experienced investor, that can give a fairly accurate result. It's a fairly tried and true test. It's been around for 2 decades and it works reasonably well. But in order to deal with this stated preference problem, we at Life Sherpa also use a money personality test. And this is a reveal preference. So it asks questions about how you feel about lots of things that are not necessarily money related. So that's why we use a money personality test, which looks at 13 psychological traits about how you deal with money. So it reveals why you do what you do with money, much of which is deep-seated, some of it's childhood related. It's the stories we tell each other about money. And when we put those two together, it gives us a really good assessment of your tolerance for risk. And so pulling those together, that will guide you to asset allocation. And asset allocation, the spread among the 5 Bs, and within those 5 Bs, we talked about factors in a previous episode. So how you split your money up between those is asset allocation. And it drives 90% of the risk and return in your portfolio. So it's critical. We start off with a high-level asset allocation. This is a growth to defensive split, and that's often what gets referred to as a balanced or growth or high growth. So typically starting with a low allocation to growth might be conservative. These don't have any legal meanings. People use them to mean what they want them to mean. In Life Sherpa speak, a high growth is 90% growth. Growth is 80%, balanced is 70%, and conservative is 50 to 60. But wherever you see these words used, it's really important that you look beyond the word and look at what the user of those expressions means. But generally, the higher up the risk spectrum you profile, the greater the proportion of growth assets that should be included in your portfolio. And that's the start of putting a portfolio together. In the next episode, we'll look at how you then turn that into a selection of funds, shares, bonds, or whatever. And so just to summarize all of that, risk and return go hand in hand. You want to make sure you're being rewarded for the risk that you're taking. You want to make sure that you're taking enough risk to achieve your goals, but not so much that you won't be able to stay the course. And diversification matters. So till next time, see you on the other side.
Thank you for listening to This Is Investing. Any advice is general financial advice and does not consider your objectives, financial situation, or needs. You should consider whether the advice is appropriate for you before acting. Always read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs before buying any financial product. Vince Scully is a representative, and Simo Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa Proprietary Limited, which holds Financial Services Licence 451289. And if you want further investing fun, the Quick Start Guide to Investing, as endorsed by Vince, obviously, is available wherever good books are sold, or there's a link in the show notes to get your copy today.